Everybody, thank you for joining the ACA Small Business Boot Camp for this Tuesday, December 6th. We're excited to have you with us today. We've got a great lineup in store. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services, and I'll be your host today. And we've got great presenters from our friends at REDW, and we'll get to that here in a little bit. But as we like to do, we like to start by first thanking all our community partners. We cannot do these webinars without their time, their effort, and their expertise. They've all been great partners in the boot camp series since we've started, and they continue to be great partners with the sessions going forward. So those that are new and haven't been on the boot camp before, the Small Business Boot Camp is designed to help small businesses prepare, plan, and grow. And it is a statewide initiative supported by all of our community partners. For example, last week, our presenters were from Sierra Vista, Arizona, so down south. And so we bring our partners in from all over the state. And not only is it our weekly webinar on Tuesday mornings, 9 a.m., it is a content library and a series of workshops with those community partners. So the workshop piece, we like to do a workshop every quarter, sometimes more than once a quarter. And we are planning our 2023 series now. We were going to have some access to capital workshops again in 2023, along with some tax workshops with the Department of Revenue. We are working on finalizing those dates. So we've got a great lineup of workshops that will take place in the first and second quarters and throughout the year. And the content library is where we house all of our webinars and workshops. So there's no cost, of course, to attend these webinars. There's no cost to access the content library. And the content library features all of our recordings. So we record each webinar and workshop, and we post those here so that you can go back and review them at any time. And we get a lot of people that just can't attend Tuesday mornings. And so they can go back and watch the material, access the slide deck when it's convenient for them. And so this is a great resource. Feel free to share this with anyone. This is, again, it's on the internet, so you don't have to be in Arizona to access the webinars and the content library. It's just a wonderful resource to support small businesses where we may be. The ACA also has a number of programs to help support small businesses. So we have our small business services, our workforce, and our Arizona MVP, our manufacturing extension partnership. These programs are here to support you as you continue to start and grow. So if you have questions about them, feel free to reach out to me directly and I can get you information about them or in contact with the program managers for those programs. Additionally, we have our small business checklist. And this is an online interactive resource to help entrepreneurs that are starting or expanding their businesses into new areas understand the commonly requested licensing and registration and compliance needs at the local, state, and federal levels. There's also a lot of other information on there. It's a tremendous resource. It's very in-depth. And as you can see on the screen there in the lower right-hand corner, you'll find our virtual assistant, Sally, and she can help you with a number of other questions with resources from the checklist in a much simpler and quicker way. But if you want the deep dive and the full information, dive right into the checklist and you will get a ton of great guidance and resources. So with that, we want to look at some quick updates. On December 14th, next week at 12 p.m., we're going to post a link for this in the chat. The Mojave Community College Small Business Development Center, along with the ACA and another partner of theirs, is hosting an ERC, an Employee Retention Credit webinar. I'm sharing it here because it's a great timely topic. So instead of doing a special session for our boot camp, we just want to plug this one that the SBDC is hosting because the ERC, you've heard a lot of commercials probably for it lately. Third-party companies that claim they can get you a lot of money back, and that may be possible, but the IRS has actually shared some warnings about some of those companies. So we're helping this in this webinar to make sure that correct information is being shared so you can make the best decision for your company. So feel free to join that. And then also just to note that the IRS has a great website for steps to take now to get a jump on your taxes. No one wants to think about it, but as we'll find out in today's session, the sooner we get 2022 behind us, the easier it is to focus on having success in 2023. So with that, we are going to look at some of our upcoming sessions to wrap up the year and jump into 2023. So next week, we have our business succession planning. If some of you are thinking about, hey, I might want to sell my business or exit it within the next few years, this is definitely a session that you want to take a look at and be part of. And because selling your business is not just something you do off the cuff, it's something you want to plan properly to maximize the value of your company. Then we're going to take a holiday break and we will resume on January 10th. And on January 10th, we're going to have handling difficult customers. We're excited about this session. And then following up that one will be business planning for a strong 2023. So making sure you have a good plan to start your year. So hopefully you can join us for those. But until then, we have today's session and we're looking forward to it. So today we have Curtis Balls and Jeremy Miller, both CPAs from our friends at REDW. They've been partners of ours with our workshops and our boot camp. So we're excited to have them with us today. And so with that, gentlemen, I'm going to go ahead and stop sharing and turn the time over to you. So Jeremy can share his screen and get his presentation up there. And in this, please put your questions in the Q&A. We can track them much better there and they won't get lost in the chat. So questions in the Q&A, chat back and forth, or interaction with our presenters can go in the chat. And Jeremy and Curtis, it is all yours.
Perfect. Thank you, Robert. Appreciate the introduction. Yeah, as Robert mentioned, I'm from, Jeremy and I are from REDW, a local tax and audit consulting firm. Have offices here in Phoenix, Albuquerque, and Oklahoma. And then, in the remote environment, we have employees in, a dozen plus more states. And we serve clients primarily here in Arizona and Albuquerque, but also we have a large tribal practice and we have a lot of other clients that we serve in probably 45 of the 50 states here in the United States, and then also have international operations. But we do focus a lot on the smaller entities. I serve the nonprofit space and the commercial space on the audit side. Jeremy, same on the commercial side. He serves on the tax side as one of our tax principals. But today we're going to talk about how to tackle your year-end financials and prepare for the year-end, the year ahead. So if we want to switch over, Jeremy, to the topics we're going to cover. The way we laid this out, based on the audience, we wanted to talk about closing your books, recording year-end accruals. These are kind of the topics, running internal financial reports, preparing for an audit review or compiled financial statements, depending on where you're at in your business and the growth projection there. And we wanted to leave at the end kind of important things to think about at the year end as well, which is tax planning, pass-through entity tax elections, and then the changes in the Arizona tax rate. So that's kind of where we're at. Leave that last tax, strategy discussions. That's more important than just recording your adjustments in the books and stuff. It's tax planning and seeing how we can save the most money and pay the right amount to the IRS, but not too much. All right, so starting off, Jeremy, anything you want to add?
Not to the topics covered. I think we're ready to jump right in. We can kind of go through it and answer any questions you guys may have at the end. I'm happy to be here and presenting. So with that, we can jump into the first topic, closing your books. So I was just going to mention, for a tax perspective, closing your books is important. Making sure that your financial statements are what we call tax ready. So that would be making sure if you have a prior year tax return, make sure that your balance sheet is matching the prior year tax return. Make sure your retained earnings or equity rolls from year to year. If it doesn't roll, go back, look at your adjusting journal entries your accountant gave you for the prior year. Make sure you've made those. Make sure, in order to avoid double counting, overstating or understating income, make sure your bank reconciliations are up to date for the year. You should be doing that monthly. Some businesses, depending on size, do it quarterly or more regularly, but you should be doing that monthly if you have time to do that.
Perfect. And so, yeah, that on a tax basis and on a GAAP basis. So I live more in the GAAP world, and obviously Jeremy more in the tax world. If you're looking at the accrual basis of accounting, and it would have been nice that we should have inserted some polling questions to understand the nature of the participants, whether your books are recorded on a cash basis, accrual basis, or a modified accrual basis, you know, from a tax reporting perspective. But if you're on an accrual basis of accounting, some of the things you want to make sure we noted down there is, you know, that your accounts receivable is recorded accurately. You have proper cutoff as of your fiscal year end. Prepaids are important to evaluate and make sure that you have those recorded appropriately. You'll provide those to if you have compiled financial statements or GAAP, any type of GAAP financial statements, they'll want to see those listings. Also, from a tax perspective, they'll want to look over your prepaids just to make sure that you're taking the proper deductions appropriately. Inventory at your end, you'll want to do a physical count, make sure that those balances are accurately reported, that you have the appropriate costs in the appropriate year. Fixed assets, property, plant, and equipment, again, reconcile. And if you're on a book basis, you have your book depreciation, which is different from tax depreciation. Often tax, you know, you have your accelerated methods. And so we want to make sure you capture those appropriately depending on the basis of accounting. Accounts payable, you know, again, year end cutoff, looking at that and accruals. We'll talk a little bit more about accruals on one of the next slides. Jeremy, were you saying something?
Yeah, I was just going to say, you know, even if for tax purposes, you're on a cash basis method of accounting, it's still important to know your accrual basis of accounting as a tax preparer. We do we make adjustments to that. We do an accrual to cash adjustment to get you to cash basis. But it's still important for tax to know these accounts because there are other accruals that will, you know, on the next slide, we'll go over more different accruals and prepaids and different things like that. But having accurate AR and AP helps us on a cash basis accurately report that cash by making the adjustments. Sometimes QuickBooks and other bookkeeping softwares will force a cash basis balance sheet. And sometimes there's additional adjustments we need to make there because you've been recording it on a cash basis, but QuickBooks defaults to accrual and you can kind of force it back and forth and it can create some errors. So it's important to make sure that you're reporting all your AR and AP and prepaids, even if it's not hitting cash. So QuickBooks doesn't force an adjustment and create a weird account. Sometimes they have these weird opening balance equity accounts for adjustments and it can mess up our tax readiness. So making sure that your accrual accounts are accurate is very helpful for tax prep as well.
Perfect. Yeah. And then just overall, I think it's just making sure that those all reconcile to your trial balance. And if there's any differences, you know, the reason for those differences. Hopefully there's no differences. Then, you know, from an accounting perspective, we're always looking to be consistent in our reporting. You want to make sure that your one year to the next is comparable. And so you want to make sure that those accruals are consistently prepared. So one way to do that is compare your year-end balance sheet to the prior year-end balance sheet and also your income statement. And hopefully, you know, the reason for any significant fluctuations between, you know, year over year. Another thing I think Jeremy kind of already mentioned, making sure your retained earnings rolls. So we always like to have an equity statement to make sure that agrees to the trial balance. So kind of closing the books there. I guess we can go to the next slide, Jeremy. Go to recording your year-end accruals. So a few things we put here is just, you know, learn from the past. The best practice is reviewing the prior year-end accruals, as well as any adjustments proposed by your accountants and ensuring those same accruals are considered for the year-end close. So I think in the previous slide, Jeremy mentioned looking at, you know, whatever adjustments were recorded in the prior year. If you want to discuss that with your accountant and make sure that those are recorded appropriately in the current year. That way, again, from a consistency perspective, the books are in order. Some of the common accruals that we see, obviously there's a lot related to compensation. So you'll have your payroll accrual based off of, when work was performed compared to when the end of the payroll, the paycheck was paid. So sometimes that's a week lag, sometimes it's 2-week lag, depending on, sometimes it's different between salaried employees and hourly employees. So just make sure you have that recorded. Any bonus accruals, benefits, vacation, 401k, and then commission accruals are kind of the consistent accruals that we would record on a GAAP basis. Jeremy, you want to speak about, tax, what the tax deductions for, bonuses and how quickly that has to be.
So if you are on cash basis, which a lot of our small businesses are on cash basis, then what you've paid out by December 31st is really what you deduct for the most part. If you are on an accrual basis for tax purposes, there are some special rules for accruals that we need to know. So we still may have adjustments. There's a rule called the all events test that has to be met, which means the liability has to be reasonably estimated, and the services have to be performed in order to deduct the accrual. There's different ways to measure changes in accruals for tax purposes that that help us determine the tax basis of those accruals and how much or if any we deduct. So for example, compensation like payroll, bonuses, vacation accruals, anything that's compensation based has to be paid out within 3.5 months of year end, or by the time the March 15th tax deadline for SCorps or pass-through or partnerships are due. If the compensation is not paid out in that time period, then it's non-deductible. So we need to have information on that. So in addition to recording your year-end accruals, you want to have a way of tracking your expenses on a month-to-month basis to make sure that we're accurately deducting the right amount. A lot of bonuses are paid out in January or February. Commissions are usually a monthly thing. So usually there's not an issue meeting those rules. Payroll is not usually an issue. The ones we have issues with are vacation accruals, because employees are not consistent on when they take vacation, and that can be an accrual that may not be deductible on an annual basis, depending on your employees' needs. For general expenses, the same rule applies, called all events test, but there's an 8.5 month rule for those accruals. So any expense paid out within 8.5 months or estimated to be paid out within 8.5 months is typically deductible. There's also what's called a reoccurring item exception. So if you have, like rent expense and it's a monthly thing, and you're paying in January, or, you pay in December for January rent, if you just kind of have a month deferral every month, then that's a reoccurring item because rent's a monthly expense. So you get to deduct it. You get to deduct the year-end accrual on that if it's an annual accrual. And that's why I think it's important, that first statement, learn from past, review your prior year-end accruals. If you have the same accruals year over year, typically you're going to meet the recurring item exception on that. Deferred revenues, we have different rules for tax than we do for GAAP or financial statement purposes. You only get a 1-year deferral when you've received revenue. If you're cash basis versus accrual basis, then deferred revenue is all picked up when the cash is received. So under cash basis, it's a little easier to measure. If you are accrual basis and you have deferred revenue or long-term contracts we have to look at, then that takes a little bit more analysis, and we might want to start thinking about those. Prepaid expenses, if prepaid expenses, for example, insurance contracts, a 12-month contract, and you pay it in November, and you typically expense it throughout the year for financial purposes, as long as the prepaid contract is done within 12 months, you can deduct it for tax purposes. Cash or accrual method on that one. So very similar to audit, but we use the information for different things, but we both need the information. So it's important to get your year-end accruals, even if you are cash basis, as I mentioned before.
Okay, so that leads us right into running internal financial reports. So often, you know, as you're growing, there's different users of the financial report. You know, sometimes it's for bank lending, sometimes regulators, depending on the size of the entity. Sometimes it's just for internal reporting, so you know the owners can understand the nature of where the funds are going. So a couple of bullet points here, four bullet points actually. We just want to make sure, first thing, when you're running internal financial statements, that you identify every single one of your business financial transactions. So have a method to track each of your payments, your receipts, and make sure that you can have that to have a smooth running accounting process. So tracking it. Sometimes, you know, it's smaller startups, you don't have the bandwidth to do this on a daily basis. So you just need to have a process in place to do it on a weekly, you know, a set timing for that. Reviewing the ledger and journal entries line by line to see where any errors may have occurred, right? If there are any errors. So again, somebody who's familiar with the nature of the operations, you know, the operation guys can help you as you're reviewing the financial information. Then as you finish adjusting entries and reach the end of the accounting period, you will prepare your financial statements that includes your adjusted trial balance alongside all relevant statements. So once you have your information all in your trial balance, then, you know, if you're using QuickBooks or another method, you can spit out the income statement, the balance sheet, statement of cash flow. And it's best practice is try to get that as timely as possible. So those who need to review the financial information can do it real time while the information is fresh in their mind. So the last comment is, you know, this provides external entities like banks and regulators, as well as your own internal financial review team with the most accurate picture possible of your business overall financial status. So again, from a internal financial reporting standpoint, it's best to be as timely as possible. We have clients that are able to close in, you know, within the first week, but I also have other clients that take months to close, and the ones that typically are closing their month end and year end financial statements quicker are usually ran better and are more profitable because that information is real time to the owners who can then make educated financial decisions for running their business. Next slide, Jeremy. Unless you have anything on that from a tax perspective, nope. That's more gap.
That's more gap, yeah.
So this leads right into, you know, if you're at the point where you need compiled financial statements, review, and audit, let me just give a basic definition of those three, right? So there's different degrees in scope of assurance that are between compiled financial statements. Each of those are done by a third-party CPA firm. So on a compiled set of financial statements, all the CPA is doing or accountant is doing is compiling the financial statements. They're putting the financial statements, they can be just statement only, income statement, balance sheet. It can be income statement, balance sheet, statement of cash flow. And then you can also have all three statements, a statement of equity as well, potentially, and the full disclosures. On a compiled set of financial statements, they're the only ones where you can actually have your CPA who's not independent. So they'll just have a statement on that report that we are not independent in respect to this account or this client. So say your CPA is helping with your year-end accruals and is highly involved in your accounting, he or she can still put together a compiled set of financial statements for you. And there's really no assurance on the accuracy of the information. It's based off of the information that was provided by management. A review goes a little higher where there's a little bit more of an inquiry and analytic that we have to be independent. The CPAs have to be independent with that. And that would be a review on the full set of financial statements. So you don't have the option of going, you know, bare bones, just the statements. You have to have statements and the full disclosures that would be in accordance with the generally accepted accounting policies. And then the audit is the highest level of assurance. Audit, we're going in there and doing analytics, review, inquiry with the client, and also doing substantive testing on a sampling basis to the details. And banks, when you're looking for financing, obviously some you're good if you aren't highly leveraged with. The banks are good with just compiled financial statements. As you get more moderately leveraged, you'll probably have to move up to a review. And then if you're moderately or you have high loan balances, often the banks will require an audit. And then obviously public companies are required to have audits. So going through this, as you're preparing for any of those, whether it's compiled or reviewed financial statements, you just want to make sure that all your reconciliations are complete at year end, or month end if you're doing month end compiled financial statements.
Yeah. I would like to add that requirements for audit and reviews are mostly loan-based, but not always. Like specifically in the construction industry, you can have bonding requirements, and if you have a bonding requirement for insurance, they may require a review or an audit depending on what that bond is worth. So you may or may not need an audit depending on insurance requirements as well as loan requirements.
Loan, yeah, sometimes regulatory requirements, and also if you receive federal funding over a certain threshold of 750,000, then you're required to have a single audit and report to the federal government on those fundings received in a given year. 750,000 is the threshold for that. And there may be others, it's more regulatory and bank. Thanks for bringing that up, Jeremy.
Sure.
Okay. And then, yeah, best practice is to have that year-end planning meeting with your accountant prior to year end. This will help you, prepare for a compiled financial statements. We often like to do it, like Jeremy and myself, we'll go out together. That way you do kind of a year-end financial statement from a GAAP perspective, and also tax and tax strategy, and make sure that you're based on where you're at from your tax estimates, that you're planning accordingly and taking as many deductions and planning for what deductions you want to take in the current year, potentially accelerating some if you have a high taxable income and you're not expecting high taxable income in the following year. Again, just review, from that, review any requests from the accountant, gather all the relevant information to send to your accountant. Often that's best practice to do that as you're closing out your year end, and then communicate any deviations from the agreed upon timeline. So if you agreed to give everything to the accountant after 1 week, let's say, and you realize it's going to take 3 weeks, then just communicate. That way schedules can be adjusted and there aren't any further delays, or you can eliminate the risk of significant further delays in the schedule with the accountants.
And specifically on timeline, I just want to point out from a tax perspective, if there is a requirement for audit or review or compiled financial statements to an extent, typically we won't prepare or touch the tax return until the audit or review is finalized, because of any changes being done will affect the tax return. So if there's any deviations from the timeline, or if you have a review and a tax return, and there's issues with getting requests or communications, then that's not just delaying your review, it's also delaying your tax return. So we want to make sure that we're doing everything timely, in order to make sure, audit might have a quick turnaround, but we may have to extend your tax return if you have an audit being done, which gives rise to additional requirements for extension prep. So
perfect. Yeah, and then at the end, once the trial balance is final, once you have all the adjustments incorporated, it's time to take that information from your temporary account. So basically closing out the year, your income statement to your balance sheet, and push that into retained earnings. And then we're off to the next year. And hopefully I saw that the ACA has a little bit of a budgeting, planning, and all that workshop as well. So that's, at year end, you're often doing a lot of budget planning. And so you'd be off to your next year after that. Jeremy, on to taxes, I think.
I think we are. So here, I just kind of put together a couple of our year-end tax planning items that we discuss with clients. So one is bonus depreciation. So the Tax Cuts and Jobs Act of 2017 changed bonus from 50% to 100%. So what that means is if you have to capitalize assets, so let's say you need to buy equipment for your business, or a computer, whatever you need that has to be capitalized instead of expensed directly. The Tax Cuts and Jobs Act for the last couple of years has allowed 100% deduction on that, or immediate write-off for tax purposes. That's what Curtis was kind of talking about earlier, where we have different depreciation methods. We have these accelerated methods. 2022 is the last year that you get 100% depreciation in the first year, called bonus depreciation, for any asset that's has a under 20-year useful life. 2023, it will go down to 80% every year until bonus goes down to 0, I believe. So if you're looking at your year-end planning and you think that you're a little higher than you are right now and you maybe need a new piece of equipment in January, you might want to buy and put that piece of equipment into service at the end of December and benefit from 100% deduction rather than waiting until January. That's if it's economically feasible to purchase, and if you can kind of project your 2023 year as well and know that you won't need it as much in 2023 for the deduction portion. So just be considering bonus depreciation and how you're going to lose some benefits over time starting in 2023 for accelerated depreciation. So you want to be careful about that. Another item that Tax Cuts and Jobs Act gave was with the reduction of the corporate income tax rate from 35 to 21%, in order to help individuals who have pass-through income from S-corps and partnerships, which is basically the small businesses. They gave us something called a qualified business deduction. So there's a 20% deduction for pass-through entities, but it is limited to wages and or assets. It's either 50% of wages, or I think it's like 5% of your qualified business assets that you have in your business. So if you're heavy on your fixed assets, you usually qualify for this, or if you're heavy on wages, you qualify. There are some minimums. So there are, if you make under a certain threshold, and that number changes every year, I don't have it on the top of my head. If you make under a certain amount, you qualify for the 20% without having to look at wages or fixed assets. But if you're above that threshold, you do have to look at wages. So there is some planning involved there where we can look at year-end bonuses and payments to owners or employees in order to maximize that qualified business deduction for the year. The other item was S-corp election. I don't know if anybody in the ACA has had classes on entity election for tax purposes, but there are different types of entities you can create. For LLCs or corporations, you can make an election to be treated as an S corporation. You get pass-through treatment. You don't get self-employment tax, but the other side of that is you have to pay yourself a salary through a W-2 in order to pay Social Security and Medicare that way, rather than being subject to self-employment tax. The benefit there is we pass through 100% of your income. So if the S-corp makes $100,000, you have to pick that up on your personal return. Well, you may only be paying yourself a salary of $30,000. So you're paying self-employment on that $30,000 rather than paying it on that full $100,000 net. So there's a pretty big benefit there with the S-corp. There are some stringent requirements for an S-corp. Like if you have more than one shareholder or partner in an S corporation, everything has to be pro rata, which means if you're 50-50 partners, everything has to be split. Distributions, contributions, allocations of income have to be split exactly how the ownership is. The only downside of an S corp is if you have appreciated property. So if you're in the rental business or property development, you really want to avoid putting or like rental property or highly appreciated property into the S corporation, but it is a viable option. So for all of you who have brand new startup businesses this year, it may be something you want to take a look at. You can elect S corporation 75 days after you start business or have your LLC or corporation. But if you've never filed a tax return, you can elect late, but as long as you file it with the S corporation tax return. So there is an opportunity there to save some self-employment tax and save some significant money. And if you actively participate in this in an S corporation, you're also not subject to the net investment income tax on that income as well. So there's some really good benefits of an S corporation. If you guys have accountants, make sure you're asking them about, make sure they're taking care of your entity elections and have discussed these options for you. The last piece of year-end planning isn't really related to the business, but more of you as an individual. Most small businesses are set up as pass-through entities, which means you're picking up all the income. And sometimes it's hard to have a 401k plan or have a retirement plan set up if you're self-employed. But there's a couple different self-employed retirement plans. One's a SEP, one's called a simple plan. And you get some really good benefits. You get deductions for contributions. So your company can contribute up to 20% of your self-employed income annually. The company will get a deduction for it. So you'll get a reduction of income and you'll get a nice start on your retirement planning. For simple plans, a lot of S corps use simple plans. They're pre-tax contributions on the employee side, which means your W-2s are reduced for your taxable wages if you contribute. And then if your employer can contribute as well, and they can get a deduction on the business side. So that's really a win-win. These plans, because they're set up for small businesses and self-employment, you can set them up quickly. There's less administration on it. There's less of a time requirement. They're really good options if you're a small business, you have a little extra from your business and you want to start thinking about retirement planning. So I just wanted to bring that up. I could present for hours on different planning. These are just kind of some of the ones I picked out to discuss because I think they're important for smaller businesses. The other consideration is most of you small businesses are in Arizona. I don't know if any of you are in multiple states, but in 2017, because of the Tax Cuts and Jobs Act, on your personal individual returns, Tax Cuts and Jobs Act limited your Schedule A deductions for state and local income taxes. So that's your property taxes, sales taxes that you pay personally that you can deduct, and state income tax that you deduct to $10,000 per year. Now, what Arizona has done, and as a lot of other states have done, is created a workaround for that. So Arizona, starting in 2022, has allowed S corporations and partnerships to elect to pay their state income tax at the entity level and get the deduction on line one of ordinary income of the partnership or S corporation, effectively allowing excess state deductions. You'll still have a Schedule A, and that will be limited to $10,000. But under the outside of this election, you would pay state taxes at your individual level, and then you wouldn't get a deduction at your federal level. Under this one, you get a reduction of your federal income taxes. For state purposes, you would still pick up income tax, but you would get a credit for taxes paid by the partnership or S corporation in order to reduce or eliminate your Arizona tax. The only caveat here is the Arizona credit, if you elect to do the pass-through entity, is you can carry it forward up to 5 years, and it's non-refundable. So that one you may need to be wary about. You don't want to, we would want your accountant to do an analysis on this to really ensure that the pass-through entity election is right for you and or your partnership and additional partners. But this is one of the newest things for 2022 taxes that we're getting ready to start implementing in 2023 for the filing year for 2022. All right, the last change is Arizona did have some tax rate changes. In 2021, Arizona was on a 4-tier bracket system. So you would start at 2%, you could go all the way to 4.5% income tax rate. In 2022, legislation updated it from 4 brackets to 2. There's a 2.5% or 2.55% tax bracket for income up to 27,000, 54 for married filing joint. Any excess is taxed at 2.98%. So, and then for 2023 and beyond, Arizona is going to be moving to a flat tax of 2.5%, which is one of the lowest state income taxes in the entire country. So, as we're going into 2023, it's a little late for 2022, but Arizona has updated their withholding requirements because of this flat tax. So if you are a small organization that does have employees, make sure that you're downloading the most up-to-date payroll withholding forms for Arizona and having your employees resubmit it, or they may end up withholding more than they're required to next year. Those are some of the changes, at Arizona level. That's really all we have for the presentation. Now we can open it up to questions.
Excellent. Thank you, Jeremy and Curtis. So we do have a number of questions in here. There was one about property tax accruals. I believe you already addressed that. Is that correct? It says, how are property tax accruals given that they are always the current November payment and previous year May payment?
Most of for individuals or for a partnership, in the context of partnerships, if you have a rental property that you're renting and that's part of your business activity, then you can accrue the payment that is due in May at December, I believe. On a cash basis for tax purposes, you would deduct it when it's paid. It's not necessarily something you'd have to accrue if you wanted to, but what's your take on it from a financial statement, Curtis?
Yeah, that's exactly it. So the amount that is due in October, typically, we have some clients that will pay it all in December. I think in Arizona, you can pay it all by December, whatever it is, and not have a penalty for the amount that was due in October. So we have some on a tax basis where they're a cash basis where they'll just pay it all in December. But from a GAAP perspective, again, the amount that you paid in October, if you paid that first half, that would be an expense. And then we would accrue the second payment from a financial reporting if you're a calendar year end. Obviously, if you're an off calendar year end, then you kind of have to accrue pro rata based on the period that the property tax is related to compared to your fiscal year end.
Right. And if you did accrue it and you were on the accrual method of tax, this would be, because property tax is an annual requirement, you would meet the reoccurring exception and you would get to deduct it for tax purposes.
Perfect.
On your business side. On the individual side, individuals are pure cash method. You wouldn't be able to deduct it until it's paid.
Excellent. Thank you. So another question, and you recently touched on it, is it too late for my LLC to get started with the S corporation since I've opened for business for over a year now?
So S corporations can be elected at any time, depending on what the entity setup is. You can elect to do it on a going forward basis. So you can make the election for January 1st, 2023 as a planning strategy and implement it for next year's tax, not the 2022 tax year coming up, but the following year. Or if you've never filed a tax return yet, if this is your first tax return you're filing, you can file under a revenue proc, a late election, to be treated as an S corp the entire time, as long as you haven't filed a return under a different status. So there are options to go retroactively if you haven't filed a return. If you've already filed a return, there's options to do it on a going forward basis.
Excellent. And then another question is, are there a list of accounts that have to be closed at year end?
So year end, you would close out all your income statement accounts, right, to the balance sheet. And so that's really where you're closing. And then again, what I like to do right after you do that is make sure that, based off of your year-end financial report, that your equity rolls right then, right? Once you close out, have all the adjustments from the accountant, whether it's tax or GAAP, and then just make sure your equity rolls forward, your retained earnings rolls forward.
Excellent. One more question here. Again, if you have any questions, please post those in the Q&A box. We have time for some more questions if you have them. We have another one from Sarah. Says, is there a class I can view that would be like Tax 101 or Taxes for Dummies? I feel like some of this is over my head as a newer business owner, but we have grown exponentially and I need to learn fast and get some professional help or hire some help.
For tax, I'll let Jeremy answer that one first.
Yeah, I mean, a lot of accounting firms can, be your hand to hold, as you're growing your business. We like to grow with you. We could definitely, reach out to any CPA firm and they're willing to meet with you and kind of walk you through some of the challenges. But again, like look at look at Robert's group at the ACA. They're always holding different class seminars throughout the year, their boot camps. And, REDW is happy to participate more and do more for that, on the tax side of things. So I don't have anything. There may have already been some tax classes that the ACA's held. I don't know that though, but I know our firm, we post articles and publications on our website of various tax issues throughout the year. So you can always look at those. A lot of other CPA firms do that as well. So there's a lot of resources out there as you're looking.
Yeah, we have done some workshops. We did one with the Arizona Department of Revenue, and I'll actually post the link to it. It was focused on transaction privilege tax more than anything.
I would just second what Jeremy said, reaching out to a CPA, hopefully most of them have the heart of like a teacher. We don't want to sound like we're in this world where we're talking all these complex tax codes, right? We want to dumb it down to your level, and we want to teach you and make sure that you're comfortable with the tax position that you have, and make sure you understand it. Because if you don't understand it, then it's hard for you to sign that tax return. So there are, from a CPA perspective, there are CPE courses that you can take as well that can help you on specific topics, kind of like Robert mentioned for the excise tax for Arizona Department of Revenue. But if you're looking more of a general knowledge, it's best to just talk to your tax accountant, to be honest with you, or find somebody that you can call. I mean, most CPA firms, they'll take a phone call if you have some specific questions and give you 30 minutes to an hour of free advice, basically.
Yeah, and I would recommend, just from the experience of working with a number of different businesses and talking to them, and over the last couple of years seeing this example, is if you're growing, I would recommend you're working with an accounting firm or bookkeeping, someone to help you with your numbers and your accounting process. Because as you grow, it's going to be harder to go back and fix things you might be doing wrong. So it's better to get everything set up correctly as soon as possible on the front side, to make everything easier as you continue to grow and scale.
Yes, very good point, Robert. It's great. It's so much better if you set it up right in the first place, whether it's that tax structure or even your chart of accounts, your financial statements. If you start off wrong, and you're just going to continue wrong, it's going to become a more larger tangled mess. So
right.
All right.
We have another good question here. It says, do you have any suggestions for startup costs as tax deductions for new small business single member LLC that is not launched yet?
That's a great question. So there are some special rules with startup and organization costs, right? Like if you're, different startup costs can be things like market research, product research and development, advertising can be a startup fee. Professional and consulting fees can be that. Purchasing of equipment can be startup costs that you can capitalize and depreciate, potentially accelerated depreciation at 100%. You know, there's also an organization costs like incorporation fees, partnership filing fees, legal fees, items like that. However, there is a cap for tax purposes of $5,000 for startup fees that are deductible. Anything in excess of that will be capitalized and amortized over a 15-year period. So you don't want to get excessive on startup fees just to try to jump into some additional deductions, because you are limited in what you can take right off the bat. But we do an analysis, you know, as your CPA, if you're a startup, we would look at an analysis and really determine what's a startup cost and what's really a cost of operating business from day one, and kind of differentiate those to try to maximize your deduction potential.
Yeah, there's a difference on a GAAP perspective, so just something to keep in mind. So on tax, you would capitalize those for if you had financial reporting to a bank under generally accepted accounting policies, GAAP. You are not allowed to capitalize those startup costs. So those would just be expensed as incurred. So a little difference. And so you'd have, again, a book to tax difference, but that's something that you can track. And again, as Jeremy mentioned, you amortize over 15 years.
Excellent. And then we have another question. Says, do all commercial properties need to be owned by the same company name to move from filing as an LLC to an SCorp?
Do all commercial properties need to be owned by the same company name? So if you're an owner of commercial properties that are highly appreciated, we probably don't want to be in an S corporation. But if you were in, if you had a, you know, an operating business and you also happen to own the business and wanted to separate those, you could have common ownership. You know, the individual could own an LLC separate and leave the building there and start a new business and move all the assets of the LLC into the S corporation. I don't know if that's what you're asking exactly.
Somebody was asking that, and I think, Sylvia, that might be a good question to reach out to them directly on, because I know from some previous experience that it can get a little complicated when you've got two businesses, one owning property, one owning the operations of stuff. So I would probably reach out directly.
Perfect.
Great. And I think that's it. Deborah had put a comment in the questions for you guys, but she'll reach out to you via email.
Great.
So
Perfect.
There's a question that just popped up in the chat, so I'll read it real quick. It says, if you've already started a business but haven't obtained a business license, is there a penalty? We did file taxes and owe, but we used our personal social security number.
If you already started a business but haven't obtained a business license, is there a penalty? We did file taxes and we use our personal. So there's different types of business entities, right? There's a business entity just called a sole proprietorship, and that's really just going out of your basement and filing what's called a Schedule C on your personal return. That would be using your own personal social security number, but you do lose out on that liability protection of an LLC or business. So it's not recommended to not have a business license. You can technically do it as a sole proprietorship, but if anything happened, that would be a course of liability. You could personally be held liable for that. So I always recommend setting up a simple LLC, even if it's a disregarded LLC that's still filed under your personal return with its own EIN number. That also helps you get business lines of credits at banks and helps you kind of separate your business from personal, even if it's all reported on the same tax return.
Excellent, thank you. And then one more question popped up, and this is a good one. It says PPP and or employee retention credit taxable and how accounted for on financial statements?
Yeah, so PPP loans, if they are forgiven, it's considered income from a financial statement purpose and should be reported as other income. For taxes, it's tax exempt income. So we do not, it is not taxable. The IRS made an exception here. Typically what the IRS originally said was, if you get your PPP loans forgiven, the payroll expense that you use the funds for would be non-deductible. They did eventually allow the deduction. Some states do allow the deduction, some don't. So there might be some state adjustments. I believe in Arizona, we allow the forgiveness, but other states do not. As far as the employee retention tax credit goes, is that was really eligible for the last quarter of 2020 and the first 3 quarters of 2021. If you file a claim for an employee retention credit, that would be on your payroll reporting forms. If you get that credit, you need to amend. If you haven't already filed, if you've already filed your tax returns for 2020 and 2021, you would need to amend those returns and remove the wages that you would have to offset your wage deduction for the amount of credit you get, because you can't double count your wages and your wage deduction and a wage credit. So if you got $100,000 ERC credit, then you would want to amend your tax return and reduce your wages by that 100,000.
Excellent. Then we got another one here, and this will probably wrap up with our time. It says, we received a sizable EIDL loan. Anything I should make sure I pay attention to before the end of the year, or my accountant pays attention to?
Yeah, so EIDL loans are not required to be paid back.
They are required to be paid.
Are they?
Yes.
Oh, I was looking at an, sorry, I was looking at an EIDL grant. I was thinking of their grant, EIDL grants or loans. So if you're required to pay it back, you just start paying it back. The only thing that really we would want to look at is the interplay between principal and interest on that loan. So if you have an interest component of an EIDL loan, then that would be a deductible interest expense. The principal would be on your balance sheet as a liability. Sorry, I was still in PPP mode too.
Yeah, no, totally understand that. There's a lot of confusion that happens with everybody on those different programs. So excellent. So yeah, the EIDL is just a loan that you got to pay back. Like
right.
So,
and I think it's like a fixed interest rate of like 3.5 or 3.75%. So yeah. It's a low interest rate, but that interest will help. Now, I know payments were deferred on a lot of those, so there could be some interest accruals going on as well year end, even if you haven't started making payments yet.
Yeah, so I know on those you can reach out to the EIDL Loan Center and for questions. They have people working there. So excellent. Well, thank you, gentlemen, Jeremy and Curtis. We will wrap up. I know Curtis has a hard stop as well, but we are right at time. So we'll wrap up. Thank you for joining us. We want to thank all the attendees for being here. And the recording of this will be posted within the next day or so in the content library. So we hope you enjoyed it. We hope you join us next Tuesday for our final boot camp webinar of the year before we head out for the holidays. So have a great week, and we look forward to seeing you next Tuesday. Thank you, everybody.
Thank you.
Thank you.